It is late 2025. An oil cargo changes ownership in 7 seconds. No press conference, no sanctions headline, no emergency summit. The trade clears, payment settles, the tanker keeps moving, and the dollar is not involved. That is the moment the petrodollar stops being a rule and becomes a preference. For 50 years, the global energy system ran on a simple requirement. Oil was priced, traded, and settled in dollars. That requirement forced every nation, friendly or hostile, to hold dollar reserves. It created constant demand for U.S. debt. It financed deficits without consequence. It was not diplomacy, it was plumbing. The 7-second transaction bypasses that plumbing. Nothing dramatic happens on screens. Oil prices do not spike. Markets do not halt. That is precisely why it matters. Reserve systems do not die in explosions. They die when settlement becomes optional. The transaction clears through a bilateral channel. Energy moves. Payment settles. No correspondent banks. No dollar clearing. No exposure to U.S. financial jurisdiction. The oil is real. The settlement is real. The currency layer is interchangeable. That is the failure point. The petrodollar was never protected by treaties or armies alone. It was protected by necessity. If you needed energy, you needed dollars. If you needed dollars, you needed U.S. financial assets. If you needed those assets, you funded U.S. deficits automatically. The 7-second trade removes the necessity. Once energy can clear outside the dollar, demand for dollar reserves becomes discretionary. When demand becomes discretionary, it becomes unstable. When it becomes unstable, the system enters stage 4. This is not about one country rejecting the dollar. It is about infrastructure making rejection frictionless. Clearing systems, currency swaps, commodity exchanges, and bilateral settlement agreements quietly replace a single global channel with many smaller ones. That fragmentation is fatal to reserve dominance. The United States does not lose control because others attack it. It loses control because others no longer need permission. Sanctions lose power when trade routes reroute. Monetary policy loses reach when settlement escapes jurisdiction. The public misunderstands this moment because nothing breaks immediately. Gas stations still operate, airlines still fly, prices still quote in dollars. The illusion of continuity remains. But under the surface, the mechanism has changed. A reserve currency survives only while critical commodities require it for settlement. Once oil, gas, and raw materials clear without it, the currency becomes just another claim competing for trust. The 7-second transaction proves one thing beyond debate. The petrodollar is no longer enforced by necessity, and once necessity disappears, collapse becomes a matter of timing, not policy. The machine is still running, but it no longer runs on dollars alone. The thesis: how reserve systems actually die. Reserve currencies do not collapse because of announcements, elections, or wars. They collapse because the settlement layer changes. History follows a fixed pattern, and every dominant monetary system dies the same way. Not when it is attacked, but when it is no longer required. Stage 1 is hard anchor and adoption. A reserve system begins anchored to something indispensable. In earlier eras, it was gold or silver. In the modern era, it was energy. The petrodollar worked because oil was the bloodstream of the global economy. If you needed energy, you needed dollars. That necessity created permanent demand for dollar reserves, U.S. treasuries, and American financial plumbing. Trust was not optional. It was enforced by physical reality. Stage 2 is expansion and privilege. Once adoption becomes universal, privilege emerges. The issuing state can run deficits without consequence. Debt expands. Financial markets grow larger than the real economy. The system appears stable because demand for the currency is automatic. This is the phase known as exorbitant privilege, the ability to consume more than you produce because the world must hold your claims. Stage 3 is strain and debasement. Over time, claims outgrow the physical system supporting them. Debt accelerates. Sanctions weaponize the currency. Political risk enters settlement. Trust erodes quietly. The issuing state responds by issuing more claims, not fewer. This is debasement in modern form. The currency still functions, but confidence becomes conditional. Stage 4 is the reset. The system does not fail publicly. It fragments. Settlement routes multiply. Bilateral clearing replaces centralized clearing. The currency shifts from requirement to option. At that moment, reserve status ends, even if pricing conventions persist temporarily. Paper dominance survives on screens while physical trade exists underneath. This is where the petrodollar stands now. The 7-second oil transaction is not important because of its size. It is important because it proves energy can clear without dollars at operational speed. Once that proof exists, replication is inevitable. Clearing without the dollar is no longer risky. It is efficient. That is the mechanism. Reserve systems die when necessity disappears. Policy follows settlement, not the other way around. Once stage 4 begins, reversal is mathematically impossible. The issuing state can issue more currency, impose controls, or threaten enforcement, but it cannot restore necessity. Paper claims can be printed. Energy cannot. And when settlement chooses energy over currency, the outcome is irreversible. Historical proof. The rule of three reserve systems do not fail because leaders make mistakes. They fail because the physical economy stops needing the currency that claims authority over it. History records this process clearly. Three cases, Rome, Weimar Germany, and the 1971 dollar break, show the same mechanism completing its cycle. Rome is the first proof. Rome's monetary power rested on the credibility of silver. The denarius functioned as a trusted unit of account because it contained real metal of consistent weight. Soldiers accepted it for pay, merchants accepted it for trade. Taxes were collected in it because it represented physical value. The currency worked because it was inseparable from material reality. Expansion changed everything. As Rome grew, costs multiplied. Legions expanded, borders stretched, infrastructure hardened. Political loyalty became expensive. Taxation could not keep pace with imperial ambition. Rome faced the same constraint every empire eventually faces: reduce expansion or alter the money. Rome altered the money. Under Emperor Nero, the silver content of the denarius was reduced. The coin looked identical. Its legal value remained enforced. The reduction was presented as technical necessity, not failure. This was the first break between appearance and substance. Once that break existed, it widened with every fiscal decision. Debasement became systemic. Each subsequent emperor reduced silver content further to fund immediate needs. By the 3rd century, Rome introduced the Antoninianus, a coin officially worth 2 denarii, but containing far less than double the silver. It was not monetary innovation. It was financial desperation disguised as reform. Prices responded instantly. Soldiers demanded more coins for the same service. Merchants raised prices to protect themselves from dilution. Contracts shortened. Trust decayed gradually, then rapidly. The state responded not by restoring metal, but by issuing more coins and enforcing acceptance by law. Rome did not collapse when the first coin was debased. It collapsed when money stopped functioning as a store of value. Enforcement replaced confidence. Taxes were demanded in harder terms, while wages were paid in debased coin. The economy fractured. Those close to power held land, food, and resources. Ordinary citizens held promises that lost value continuously. The reset was unavoidable once debasement became permanent. Weimar Germany is the second proof. After the First World War, Germany faced reparations totaling 132 billion gold marks. Gold marks were not abstract accounting units. They represented fixed weight in metal. Germany did not possess the reserves required to pay. The debt could not be settled honestly through production or taxation. The state chose printing. At first, the system appeared functional. Obligations were met. Workers were paid. Businesses continued operating. This early phase created the illusion that currency creation could replace real settlement. That illusion lasted only as long as confidence remained intact. As printing accelerated, velocity followed. Holding cash became irrational. Prices rose not because of speculation, but because money itself was decaying. Bread prices moved from 160 marks to billions, then hundreds of billions. Savings accounts were wiped out. Fixed incomes collapsed. The population adapted logically. People spent immediately. They converted paper into goods, land, tools, and foreign currency. Hyperinflation was not chaos. It was arithmetic enforcing reality. A currency that can be created without limit cannot function as a store of value once trust breaks. Those who understood the mechanism early survived. Insiders converted marks into factories and farmland. Exporters held foreign currency. Those who trusted pensions, savings accounts, and fixed wages were erased. The transfer was not moral or immoral. It was mechanical. Weimar did not collapse because of panic. It collapsed because claims overwhelmed physical capacity. The modern system is the third proof. After the Second World War, the Bretton Woods framework anchored global currencies to the US dollar and the dollar to gold. This imposed discipline. The United States could not issue unlimited claims without consequence. That restraint ended in 1971. On August 15, 1971, President Nixon closed the gold window. Foreign governments could no longer redeem dollars for gold. Bretton Woods ended. The final physical anchor was removed. From that moment forward, the dollar became pure credit. This created the exorbitant privilege. The United States could issue the world's reserve currency without immediate settlement. Deficits expanded, debt accumulated, financial markets exploded in size, derivatives multiplied, paper claims grew far faster than real output. The system appeared stable because confidence replaced constraint. What followed was not sustainable prosperity, but distortion. Asset prices rose faster than wages. Debt became normalized. Saving in currency became punishment. Growth was celebrated while purchasing power declined. This was not accidental. It was the predictable outcome of debasement. Across all three cases, the same sequence appears. First, money is trusted because it is anchored. Second, obligations grow beyond capacity. Third, the anchor is diluted or removed. Fourth, claims expand until confidence fails. Finally, the reset transfers wealth from holders of paper promises to holders of physical assets. Timing is the critical insight. Elites always recognize the mechanism before the public. In Rome, senators held land and grain contracts. In Weimar, insiders held factories and foreign currency. After 1971, asset owners benefited while wage earners absorbed inflation. Debasement never requires announcement. It operates silently through dilution. Inflation is not rising prices. Rising prices are evidence of currency decay. The real event is the transfer of purchasing power. The rule of three proves one fact beyond dispute. Once a system removes its constraint, reversal is impossible. No empire voluntarily restores discipline after debasement begins. Political pressure always favors short-term survival over long-term stability. The modern system is not unique. It is larger. Rome's collapse was regional. Weimar's collapse was national. The post-1971 system is global. Every pension fund, bond market, insurance pool, and savings account is tied to the same unanchored monetary structure. This scale makes the current reset unavoidable and synchronized. There is no external stabilizer left. When settlement is demanded, the system must choose between open default and silent debasement. History shows which option is always chosen. The mechanism is not breaking. It is completing its cycle. The modern trap. Energy without dollars. The petrodollar did not collapse because oil stopped flowing. It collapsed because oil stopped needing dollars to move. This distinction matters. Reserve power does not vanish when commodities disappear. It vanishes when settlement no longer requires the reserve currency. For decades, the dollar's dominance was enforced at the settlement layer. Oil producers sold energy in dollars. Importers needed dollars to buy it. Banks cleared transactions through U.S.-controlled systems. This created automatic demand for dollar reserves and U.S. debt. The arrangement did not require trust. It required necessity. That necessity is now gone. Energy trades increasingly clear through bilateral agreements, local currency swaps, commodity exchanges outside U.S. jurisdiction, and direct settlement mechanisms that bypass correspondent banking. These routes are not experimental. They are operational, they are fast, and they are expanding because they reduce exposure to sanctions, freezes, and political risk. This is the modern trap. The dollar still prices oil on screens, but pricing is not settlement. A currency can remain a unit of account long after it ceases to be the medium of exchange. This lag creates confusion. Observers see dollar prices and assume dominance persists. Underneath, settlement is fragmenting. Fragmentation is fatal to reserve systems. Once energy clears without dollars, reserve demand becomes optional. Optional demand is unstable. When instability enters the system, holders shorten duration, diversify settlement, and reduce exposure. None of this requires coordination. It is rational behavior under risk. The United States responds predictably. Sanctions expand, enforcement tightens. Financial plumbing is weaponized further. Each use accelerates the incentive to exit. This is not deterrence. It is confirmation that reliance carries danger. Meanwhile, deficits continue to grow. Without forced external demand for dollars, those deficits must be absorbed domestically or monetized. Yields rise. Interest costs compound. Monetary authorities intervene to stabilize markets. Currency dilution replaces foreign financing. This is debasement through isolation. The public experiences this as inflation without explanation. Energy costs rise even when supply appears adequate. Utility bills increase. Transportation costs bleed into food prices. Insurance premiums climb as volatility becomes permanent. None of this is framed as currency failure. It is framed as global instability. The mechanism is quieter. Paper claims remain abundant. Physical inputs become scarce relative to demand. When settlement shifts toward commodities and away from currency, the currency absorbs the adjustment. Purchasing power declines without formal default. This is why the 7-second oil transaction matters. It proves that settlement can occur outside the dollar at operational speed. Once that proof exists, replication becomes inevitable. What can be done once can be done thousands of times. The petrodollar depended on monopoly. Settlement fragmentation destroys monopoly power. No reserve system survives competition at the settlement layer. Energy exporters understand this. Importers understand it faster. Central banks respond by reducing dollar exposure and increasing holdings of assets that do not depend on another country as permission to exist. This is not ideology, it is arithmetic. A reserve currency must be needed. Once it becomes convenient rather than necessary, the end is locked. No policy speech can restore compulsory demand. No interest rate adjustment can force settlement back into a single channel. The modern trap is believing that pricing equals power. Power resides in settlement. Settlement now routes around the dollar. The system does not announce this transition. It allows markets to absorb it slowly. That slowness is deliberate. It prevents panic while ensuring adjustment. But adjustment always moves the same way. Paper dominance fades, physical settlement rises. Currency absorbs the cost. By the time the shift becomes visible to the public, it is already complete. The petrodollar does not collapse loudly. It expires operationally, and when settlement leaves, reserve status follows. After the petrodollar, the wealth transfer. What follows the end of the petrodollar is not chaos, it is redistribution. Reserve systems do not collapse by destroying value, they collapse by moving it. Paper claims remain on balance sheets, but their purchasing power is rewritten as settlement shifts toward physical reality. This is the final phase of every monetary cycle. The dollar does not disappear, it is repriced. Energy, metals, food, and strategic inputs reclaim their role as the real settlement layer. Currency becomes a convenience rather than a command. When that transition occurs, holders of paper promises absorb the adjustment. Holders of physical inputs dictate terms. This is paper versus physical in its purest form. For decades, the petrodollar allowed the United States to import real goods in exchange for financial claims. That exorbitant privilege is now eroding quietly. As oil clears outside the dollar, deficits lose external financing. Currency dilution replaces foreign demand. Inflation becomes structural. The middle class experiences this first. Savings lose purchasing power. Energy and transport costs rise permanently. Wages lag because they are denominated in paper. This is not policy failure. It is the mechanism completing its cycle. The 7-second transaction did not end the petrodollar by itself. It proved the petrodollar was no longer required. That proof makes reversal mathematically impossible. History always resolves the same way when settlement changes. Subscribe to Epoch Atlas to understand how reserve systems are built, how debasement operates, and why monetary power always collapses quietly, long before headlines admit it. This is not fear. This is structure.